RougeTrading and explore one of the most infamous cases in the history of the financial markets, the fall of the Barings Bank and the lessons we can learn from it. So, for the people who don't know what rogue trading is, it refers to the unauthorized and the often risky trading activities carried out by the individuals within the financial institutions. These rogue traders act independently, often making the large bets on the market, hoping to reap the substantial profits. However, their actions can have the devastating consequences not only for the institution but for the broader financial system. Talking about the background, one of the most notorious cases of the rogue trading occurred in the early 1990s at the Barings Bank, a venerable British institution with a history dating back to 1762. The fall of the Barings Bank serves as a cautionary tale highlighting the dangerous, unchecked risk taking and the importance of the robust risk management within the financial institutions. So in February 1995, the world was stunned when it was revealed that a single trader named Nick Leeson had brought down the Barings Bank, a firm that had weathered economic crises and wars for more than 2 centuries. Leeson was a young and relatively inexperienced trader and was stationed in the Singapore and had been given the responsibility for both trading and back office operations, essentially allowing him to monitor and report on his activities himself. This lack of oversight was a critical factor in the disaster that unfolded. So before moving to the Barings Bank, Nick Leeson was also employed at the Morgan Stanley, providing the secondary support to the traders. So that's why he was inexperienced because he don't have the experience in the trading. Talking about the trading methods that Nick Leeson used. So Leeson was engaged in a series of unauthorized futures and option trades on the Nikkei 225, Japan's main stock exchange index. Initially, he made a substantial profits, which fueled his confidence and led to even riskier bets. However, as the market turned against him, his losses began to mount and he desperately tried to cover them up by creating the fictitious accounts and fabricating the trading records. So Nick Leeson was initially supposed to be arbitraging. That is, he was supposed to be taking the two trades that are hedging for the purpose of the hedging, and they should be the risk-free profit, that is riskless profit without taking any risk. There should be a profit. The strategy he was allowed to impose, but what he does was he gambled on the futures direction of the Japanese market. So Nick Leeson sold the straddles. So solding us basically straddle is a option strategy wherein a trader sells both call and a put option on a particular security. And if the volatility is less and if the security's price doesn't move much, the trader will be having a profits. But if the volatility is high and the stock prices are moving up and down continuously, then the trader will be having a losses, huge amount of losses. And hypothetically, the losses could lead to the unexpected and maybe the unlimited losses the trader could have, but the profits are very limited. So initially he was having the profits from these strategies, but later on he started having losses which he tried to cover using the account named 5 times 8 or famously called as the 5/8 for the unauthorized speculation to cover losses. So finally what happened was he ended up losing 827 million GBP, which led to the fall of the Barings Bank. And this happened because the authorities and the management at Barings Bank was not known about what Nick Leeson was doing. So Leeson's strategy was he used the cross trading. What it means is that matching the position of the two accounts belonging to the same client. So what he does was he changed the trading prices thereon to cause the profits. So he switched the client's account with the own 5/8 account, and details of this account was never transmitted to the treasury. So the profits are always settled and cleared through the client's account, and these were reported to the management, which showed that there is having a short-term huge profits, but actually the losses were mounted to the huge amount and they were basically compiled in the 5/8 account, which have never been disclosed to the management. So why this happened? Why Bearing Bank fall? The biggest problem is of the poor control procedures which are followed by the bank. First, the main problem is the funding problem, that is maintaining a minimum balance in the account. So whenever a trade takes place, the trader is supposed to depositing a margin requirement for every trade and every transaction he imposed on the exchange. So Nick was also required to maintain the margin against the position he was taking on continuously. So that's why he was kept on asking from the funds from the Barings Bank management and the authorities. There was also a problem of the credit risk. Credit risk seemed to be when the Barings London office used to send the funds for the margin requirement, lending money of these clients to trade at exchange. So Leeson kept on asking for more and more funds, while increasing less and less clients seemed to be closing their position. And it seemed that Nick Leeson was lying to the management by telling them that the clients are liquidating their position, but actually they weren't. There was also a problem with the market risk because there was an open position in the futures contract in the Japanese exchange. So if the prices of the securities have backfired, and they basically the trading has taken place on the short straddle, which wasn't supposed to be taken place. There was also no limits, that Baring did not impose any limitation on the proprietary trading activities, because of which the Leeson was free to pass off as much trade as he wished to, and the amount mounted to so much a big amount of losses because this management haven't taken care and they weren't aware that it was a so huge amount that they are piling up as a losses. So what measures could have been taken? The foremost measure that the bank could have taken, authorities could have taken, is the segregation of the front and the back office. There should be a person, there should be a group of people, or there should be segregation of the Nick Leeson's trading activities and the person who is supervising these activities and basically reporting these activities to the management. If this would have been happened, so the losses would have been known initially only and the bank wouldn't have been failed. The involvement of the senior management could also result in the huge savings of the losses. It seemed that the management was satisfied with the short-term profit and they were unaware of the important activities of the company. There was also tougher poor control procedures, which is obviously the biggest problem in this fall of the Bearings Bank. There's also increased supervision. Management didn't step in and were mostly unaware of the activities. They should have stepped in and they should be aware of the activities that the Nick Leeson was doing. So in conclusion, the fall of the Bearings Bank and the rogue trading of the Nick Leeson serves as a stark reminder of the risk inherent in the financial markets and the devastating consequences of the unchecked greed and the poor risk management, which normal people aren't aware of. It is imperative that we learn from these lessons and work tirelessly to prevent such events from happening in the future. The stability and the integrity of our financial system depends on it, because clients will only and only invest their savings into the financial system if they are reliable enough to, so that we can give them the returns and not lie them and make the losses, huge losses, only due to the rogue traders like the Nick Leeson. Thank you.